It may be an October to remember. The Federal Reserve said next month it will begin to reverse its historic stimulus, which was put in place to help prop up the economy during the Great Recession. Its plan is to begin rolling off its $4.5 trillion balance sheet, which consists mostly of treasuries and mortgage-backed securities. Central bank officials are also hinting that one more interest rate rise this year is likely. As a result, bond yields rose and stocks were volatile. The Dow Jones Industrial Average advanced 41 points to 22,412. That is an all-time high. The Nasdaq was off 5, and the S&P 500 rose 1, also a record. Hampton Pearson has more now on the new era that the Fed will begin ushering in.
As expected, Janet Yellen and her fellow monetary policymakers left interest rates unchanged and announced the beginning of a plan to start trimming the more than $4 trillion worth of bonds and mortgage-backed securities purchased by the Fed to combat the financial crisis and the recession.
Our balance sheet will decline gradually and predictably. For October through December, the decline in our securities holdings will be capped at $6 billion per month for treasuries and $4 billion per month for agencies.
The Fed chair said there is a strong consensus among monetary policymakers for another interest rate hike this year, even though inflation is below the Fed's 2% target and hurricane damage in Texas and Florida will have short-term negative impacts on the economy.
So if there are small changes in the outlook that require a recalibration of monetary policy, we will change our anticipated path and setting of the federal funds rate.
Leading economists and market watchers are concerned about the impact of trimming the balance sheet and the likelihood of more rate hikes.
I think they have to be very careful because it's a highly levered U.S. economy, it's a highly levered global economy, and currencies and the dollar and other related assets like gold will move substantially if the Fed overstates its case.
The Fed chair sidestepped questions about how fiscal policy, especially tax cuts and a possible increase in the deficit, might impact future monetary policy. For Nightly Business Report, I'm Hampton Pearson in Washington.